Here is a simple bet. A coin flip. 50-50. If it lands heads, you win $150. If it lands tails, you lose $100. The expected value is positive. Statistically, you should take this every time. Most people say no. And not just narrowly. In Kahneman and Tversky's prospect theory experiments, participants typically needed the potential gain to be roughly twice the potential loss before they would accept a symmetric gamble. The precise coefficient, around 2.25, comes from their 1992 calibrations. But the qualitative finding held from the beginning. The pain of losing is not the mirror image of the pleasure of gaining. A large meta-analysis published in 2024 compiled 607 estimates across 150 studies and found the average loss aversion coefficient sits just under 2. Meaning, losing $100 generates roughly twice the psychological impact of gaining $100. One clarification worth making here, because the research has been contested. Loss aversion is not a universal iron law. Researchers like Gal and Rucker have argued it is overstated as a general principle, that many classic demonstrations can be explained by other mechanisms. There are certainly contexts where it weakens or disappears: small stakes, specific framings, experienced traders under particular conditions. What's robust is the pattern across monetary and risk settings. And those are exactly the settings that govern most financial decisions. Under prospect theory, we evaluate outcomes relative to a reference point. The value curve is gently sloping for gains and sharply sloping for losses. Same framework. Asymmetric sensitivity. What makes this more than an interesting quirk is where it lives. In 2007, a neuroscience team led by Luke Thom put participants inside an fMRI scanner and had them evaluate hundreds of mixed gambles. They expected to find distinct systems, one for gains, one for losses. What they found instead was that the same valuation circuits, the ventromedial prefrontal cortex, the orbitofrontal cortex, the anterior cingulate cortex, processed both. Same regions, same architecture. But the neural slope for losses was steeper than for gains. The brain was running the same software on a different setting. In other experiments, emotion-linked regions like the amygdala and insula light up specifically for losses. Multiple systems converging to make bad outcomes feel larger than equivalent good ones. The evolutionary logic for the underlying asymmetry is straightforward. In a genuinely scarce environment, gaining 100 calories when you're already fed is a marginal improvement. Losing 100 calories when you're surviving on the edge is potentially fatal. The asymmetry wasn't a design flaw, it was load-bearing. Capuchin monkey experiments have shown reference dependence and loss-sensitive choices similar to humans, though later work has suggested some effects may be driven by task structure rather than pure loss aversion, so the cross-species story is real but not perfectly clean. What isn't disputed is that we arrive at adulthood already wired this way, without financial market experience, across cultures, with brains that weight losses more heavily than equivalent gains. The problem is that we are now making financial decisions with neural hardware calibrated for scarcity conditions that no longer exist. And that mismatch has a price. The first is the most direct. In 1998, Terence O'Dean analyzed 10,000 brokerage accounts at a large US discount broker, covering trades from 1987 to 1993. He asked a simple question: When investors have a position in the red and a position in the green, which do they sell? The answer was consistent. Investors realized gains at a rate of 14.8%. They realized losses at a rate of 9.8%. Winners were sold 50% more often than losers. And when Odin tracked what happened to the stocks that were sold versus the ones that were kept, the winners that were sold went on to outperform the losers that were kept by 3.4 percentage points over the following year. Over 20 years, 3 to 4 percentage points compounding annually is the difference between a comfortable retirement and barely breaking even. This is the disposition effect. Investors hold losing positions because selling crystallizes the loss. It converts a paper position into a confirmed one. Loss aversion keeps them in the red, waiting for a recovery that often never comes, while the winners needed to fund the next move are already gone. Loss aversion here makes you sell the wrong stock at the wrong time. The second cost is subtler. In 1995, Shlomo Benazzi and Richard Thaler published a paper on what they called myopic loss aversion. Their argument, loss aversion alone doesn't explain how badly investors underweight equities. There had to be a second variable. That variable was evaluation frequency. When investors check their portfolios frequently, they see losses frequently. Stocks don't go up every day. Monthly checkers experience a loss signal more than half the time. Each loss registers at double the psychological weight of a gain. A 2016 empirical study of Dutch private investors confirmed the pattern. 44% of investors evaluated their performance monthly or more often. That group held significantly less in equities, not because of a rational risk calculation, but because frequent observation of volatility was triggering chronic loss aversion. The investors who checked less often held more equity and outperformed over time. Same market, same risk, different behavior driven entirely by how often they looked. Loss aversion here makes you hold less of the asset class that builds most long-run wealth. The third cost operates not on portfolios, but on defaults. Germany and Austria are neighboring countries. Similar culture, similar demographics, similar stated attitudes toward organ donation. Germany uses an opt-in system. You're not a donor unless you sign up. Austria uses an opt-out system. You're a donor unless you actively remove yourself. Germany's consent rate is around 12%. Austria's is above 99%. The mechanism, opting out of a default, feels like giving something up. You already hold the designation. Removing it is coded as a loss. So people don't. In retirement plan research, automatic enrollment raised participation rates from 49% to over 85% for the same reason. Not because people's values changed, but because the architecture changed what felt like losing. Loss aversion here is defending whichever option was set as the default. The fourth cost is the one people most readily recognize and most consistently underestimate. In 1985, Hal Arks and Catherine Bloomer ran a series of experiments on prior investment. In one scenario, participants were told a company had spent $9 million on a failing aircraft project with no competitive future. 85% chose to continue spending. When a control group was given the same scenario without the sunk cost information, 10% continued. One historical figure, money already spent, already gone, produced a 75 percentage point difference in decisions. Abandoning the project means admitting a loss. Loss aversion and the fear of admitting we were wrong keeps us in failing positions. It's the same mechanism that keeps you paying for a subscription you barely use because cancelling feels like confirming the money you've already spent was wasted. Loss aversion here turns past mistakes into future costs. And it doesn't stop at investment accounts. It's the same pattern that keeps people accepting lower salaries rather than risking the discomfort of negotiation. The potential loss of the offer or the relationship outweighs the near certain gain from asking. It's what drives people to overpay for low insurance deductibles, spending more in premiums to protect against small losses that feel intolerable even when the math doesn't justify it. Here is what the research makes clear, and what every effort to simply think harder will run into. Loss aversion doesn't reliably respond to expertise. In 2005, a team of economists ran experimental gamble tasks with professional traders from the Chicago Board of Trade and with student controls. The professional traders exhibited more myopic loss aversion than the students, not less. Daily immersion in volatile markets had apparently intensified their focus on short-term losses rather than reduced it. In some trading environments, experience isn't a reliable cure. It can be an amplifier. This matters because it forecloses the most intuitive solution. If sophistication doesn't cure it, the answer isn't to become more sophisticated. It's to design around the bias. Loss aversion is a mechanism. Like any mechanism, the question is not whether it runs. It will. The question is what it is pointed at. The first redirect is reducing evaluation frequency. The empirical finding is consistent. Investors who check portfolios less often hold more equity, experience less anxiety-driven selling, and outperform those who check more frequently. The bias doesn't disappear. But if you only look at your investments quarterly or annually, the signal fires less often. Put your accounts behind a friction wall. Make looking a deliberate act rather than an ambient one. The second redirect is setting defaults deliberately. The organ donation data is not about discipline, it is about architecture. Auto-enroll in your employer's maximum contribution. Set savings to transfer on the day you're paid. Make the wealth-building behavior the status quo, and loss aversion will defend it. The same force that keeps people in losing stock positions will keep them in saving positions if the default is placed correctly. The third redirect is the most powerful, and it is a design trick that Thaler and Benazzi used to raise savings rates from 3.5% to 13.5% in a single intervention. They called it Save More Tomorrow. The mechanism: workers pre-committed a portion of future pay raises to savings before those raises arrived. Because the raises hadn't happened yet, they were coded as future gains. Taking a share of a gain doesn't feel like a loss. Savings tripled without anyone spending less today. The reference point is everything. Move the reference point and you move the behavior. The study of behavioral economics tends to produce one uncomfortable truth over and over. Your brain is optimized for an environment that no longer exists. The solution isn't to fight the software. It's to understand what it's protecting and redesign the environment so the thing it's terrified of losing is your long-term wealth, not a $100 fluctuation on a Tuesday afternoon. If this changed how you think about money, new research goes up every week on the Money Brain. Each video explores the behavioral, economics, and psychology behind financial decisions most people never question. Subscribe if that's the kind of thinking you want more of. The studies and sources behind this video are linked in the description.